I'm Evan Polaski with Ashcroft Capital, and today for our acquisition update, revisiting quarter one and our outlook for quarter two and beyond, I've got Scott Lebenhart, Ashcroft's Chief Investment Officer. Hi, Scott.
Hey, how's it going? So, as
Good.
I'm sure you guys know me from now, Scott Lebenhart, I'm the CIO here at Ashcroft. I joined up with Ashcroft in 2018. It's been a fantastic ride. Loving working here, and we've bought a lot and done a lot of great things, and excited to share with you guys what I'm seeing out in the markets right now.
No, I appreciate it. And as we're just recounting, this is our fourth or fifth quarter now doing this. So looking forward to continuing this. And obviously the full bio is on our website if anybody's looking for a little more detail on Scott's background. Looking back at Q1, obviously a pretty disruptive quarter on a macro level, not for Ashcroft, but globally. Why don't you give us a high level of what we're seeing, what steps we took to try to get through that quarter?
On the acquisitions transaction side, deal flow was extremely slow, to the start of the new year. Every January, towards the end of January, is Multifamily's largest conference called NMHC. That was held in Vegas this year at the end of January. And that was timing couldn't have been more perfect to put everybody in the same room, buyers, sellers, lenders, brokers, and just everyone have a big conversation about, it was almost like a therapy session. What are you feeling? What are you going through right now? What are you seeing with your portfolio? What are your, hopes and envisions and plans for 2023? And I think that helped to calm some of the people to understand, hey, there's a lot of money out there. There's a lot of equity that is looking to invest in multifamily, whether it be domestic money, but also a ton of international money looking to invest in multifamily in the United States. Everyone feels extremely strong about the fundamentals of multifamily. We're just dealing with the capital market issues right now. And so the overall concern that everyone kind of shared with each other is concern about the capital markets, interest rates, what are interest rates going to do? And if and when there is a recession, what's the impact? How long is that going to be? Those are kind of the main themes of the conversation. From the lender side, lenders are just as eager as the equity groups are to put money to work and have loans in multifamily, because again, it performs very well. It stays occupied. It cash flows, as opposed to office. You lose a tenant, you can't find someone else to move in the next day. It doesn't work like that. Same with retail and industrial. So lenders are still eager to put money out there. But again, it's just tough to buy deals right now. And refinancing on the lender side is extremely difficult as well because of the high interest rates. And if you're looking to refinance now, you're likely going to be refinancing with a higher interest rate than the loan you currently have. So people are waiting. But a good theme that we got from that conference was that lenders are working on getting creative and coming up with new debt products to kind of meet this higher interest rate environment. They're offering fixed rate loans, the ability to buy down the interest rates, flexibility to get out of those fixed rate loans at a certain time where, we used to love the floating rate loans because they are super flexible. And now lenders are starting to try to figure out how to be flexible with that fixed rate product as well. But kind of after NMHC, just having those conversations, I think, helped calm some concerns that people had, and more deals came to the market for sale. Those are typically more, core plus in profile deals. Most of them built kind of after 2000, and even, the majority of deals we saw were probably 2015 and newer. Loan assumption deals became very popular in Q1, where the existing loan was able to be assumed by the next buyer. And this got a lot of interest because it obviously takes the volatility of the debt market out of the equation. Overall, in Q1, some of these deals will actually trade and sell. Some of them didn't hit their projected pricing and were pulled from the market. And there are a handful of deals, which was rare for the past, 24, 36 months. Deals are getting under contract and awarded, but they're not closing because ultimately the buyer is dropping out because of interest rate volatility, or the capital markets change slightly, or just the inability to find equity. So, overall Q1 was a quarter that was filled with, again, continued uncertainty, but there is some optimism as some data points did start to come out on where deals are ultimately priced. And, I know we'll probably get into Q2, but, we do see things opening up a little more from here.
I appreciate that. And I was just reading, was it yesterday? The Wall Street Journal had an article out that commercial multifamily transactions were down 74% in Q1 relative to Q1 2022. So obviously everybody's seeing it. I'm sure there's a lot of the same impacts that are affecting the single family home market. People who have long-term fixed rate loans don't want to sell. Why? Yeah. Assuming that there's no other distress in the property or other issues coming up. And I'm talking with investors and saying, yeah, we love, as we talked last quarter, we would love to see that great core plus with value add upside type potential in a loan assumption, but unfortunately so does everybody else. Yeah. Every other buyer wants that, so you're not really getting any type of discount in today's market because of that financing. So jumping kind of from the macro level to Ashcroft specifically, I know we didn't close on any deals in Q1, but how many deals were we realistically underwriting? How many offers did we have out there throughout Q1?
So we've looked at probably 100 deals or so in Q1, which is a good amount. It's definitely not a light amount. It's definitely not the highest quarter we've had with looking at deals. But a lot of that's probably deals that have not traded or won't traded. Realistically, probably about a third of the deals that we looked at actually went through the full process and were awarded to somebody, and whether or not they actually close. We looked at a lot of deals, but the common themes that we saw was a large bid-ask spread where the sellers thinks a property is worth X and we're coming back and say, that's great that you think it's worth that, but it's worth Y. The seller ultimately saying, well, I'm not a seller at that price, I'm just going to hold it. We've had a lot of conversations, and a lot of those, 100 deals or so were deals that we kind of had those conversations about where people were testing the water to see, hey, what is the market thinks it's worth? What do I need to do to get to the price that I want on it? And, that led to a lot of the limited transactions being out there. People do want to sell their deals. They just don't want to sell it at the pricing that makes sense. But of the 100 or so deals that we actually looked at and spoke to people about, we did submit LOIs on 10 deals. As you mentioned, we did not get awarded any. And although we're upset that, we're here to transact, that's what we like to do. We're comfortable because we submitted at prices that made sense for us. And ultimately, the deals that we didn't win, that we heavily pursued, most of the time it was we got outbid, and whether or not it was relationship wise or just pure pricing wise, there were some more aggressive sources of equity out there in Q1. We saw some 1031 buyers being extremely aggressive because, again, for them, there's not a lot of deals right now and they need to put that money to work within a certain time period. So they really got aggressive in Q1. We saw certain buyers that have a fund and it's coming up near the end of their fund, and it's either use it or lose it money. So you either spend the money and invest it, or you got to give it back to your investors. So we saw some groups that had kind of a time clock on their equity. And then a lot of buyers that we saw were more kind of private, more family office type buyers that were buying deals purely for cash on cash returns, not really looking at IRR and planning on holding the deals 10 plus years or so. And so when you're dealing with someone who's pricing a deal that way, we're both cash on cash return focused and IRR focused, it's tough to get to that same price point that someone who's purely just cash flow focused is concerned on.
That's good to hear. And it's, as you noted, it's always, particularly from your perspective as the acquisition guy and the acquisition group, to not be able to acquire anything. But one thing I really appreciate about Ashcroft and the broader view that Frank and Joe have set out and obviously is coming through the organization is it's better to do no deals than bad deals. And if it works out, it works out. As an investor myself, definitely something that is good to hear. There's almost value in knowing that we're not buying anything. Let's jump into Q2 and what we're kind of seeing coming forward. And some of these questions obviously go Q2 and beyond, but what are you starting to see? You had mentioned, lenders getting into some creative structures. Why don't you dive into a little more detail on that?
Our relationship lenders as well as new potential relationship lenders, and we're continuing to talk to our peers as well. Hey, what are you doing with this type of loan? What are you doing with that on that deal? How did you finance that? But right now, I mean, the real issue with lenders and the entire that capital market perspective is interest rates are so high, meaning debt service coverage ratios on deals are low, debt yields are low, and just the uncertainty on kind of where the valuation is going to end up for these properties, which is leading to lenders lending at less proceeds, so lower LTVs. You know, typically right now it's more in the 55 to 65% loan to value range, where we weren't taking it up to 80% LTV 2 years ago or so, but you know, you could have gotten loans in the 75, 80% range or so back then. So that's really pulled back, which is creating some of the issues, which is creating issues for people who need to refinance or people who want to buy but necessarily don't have that larger equity piece that you need to in order to fill that, now call it 35 to 45% of the capital stack with equity, as opposed to 25% of equity. One of the unattractive parts about a fixed rate loan is the lack of flexibility to sell out of it early. Typically there's larger prepays on that and defeasance costs and yield maintenance to unwind the securities that is backing that loan. And, you know, because it's more debt fund focused, we're seeing more balance sheet lenders, which means that these lenders are using their own money and lending it out and waiting for it to come back, as opposed to lending it out and then selling off that loan to a different holder where they're buying that loan for the cash flow expected of it. And that's where it's creating the issue. So a lot of these groups that have debt funds are lending their own money, which means that they could do what they want with their own money because it's their own money. We've also spoken with certain lender relationships on the insurance side that are, you know, they have pref equity groups within their shops, but pretty much they're giving you a typical bank loan up till 60% or so. And then they're going from 60% to maybe 70%, 75% with their preferred equity product, but to the borrower, it's looking like one loan up to 70% or so. And it's just the higher interest rate, but you're able to get proceeds that way. So again, we're continuing to see the lenders try to react to the environment that we're in today. All this happened very quickly. And so people didn't have money raised for it, you know, in the summer of last year when interest rates started to hike or so. But now they're kind of taking a step back. They're able to go to their investors, they're able to go to their investment committees and say, hey, this is what we need to do in order to fill the gap in the hole. So that, to me, there's still a lot of product that's not out yet, that's planning on launching in Q2 or Q3 based on, you know, timing of setting up the fund documents, et cetera. I am optimistic that there are some better solutions on the horizon for us on the lending side.
From that standpoint, it sounds a bit like the lenders are running the show, if you will, and causing some of this pause in the acquisition market, because clearly if people could still borrow at 2%, a lot more deals being transacted at the prices that sellers still want. But What are you seeing? You know, is that accurate and what are you seeing? I know this is a bit of a crystal ball comment, but starting to thaw that market, starting to get more transactions so that those bid ask prices can start coming down.
I hate to say that one person controls the fate of our industry, but in reality, until Jerome Powell and the Fed start to really signal that it's an end to the interest rate hikes, I think that's going to start the thawing process. And we've started to see that, you know, with his March statements talking about the peak interest rates, things like, and since then we've seen treasuries come down significantly. The yield curve has flattened and started to decrease a lot sooner than originally anticipated. So if he starts to signal that, I think that's, again, more promising. If he signals when rates may actually start to decrease and what rates may look like in 2024, again, that's going to help even more. But ultimately, once people can start to get a better understanding of what their cost of capital is going to be, I think people are going to be excited to be more aggressive on deals.
To overly simplify modeling a multifamily deal, it really is a simple math equation. And as you noted, if you don't know what you're subtracting, what the number that you're taking out of the bigger number is, you don't know whether that's going to be a positive or negative spread. So completely get where you're coming from there. Using that, and particularly with the forward curve, end of Q4, getting into early Q1, there was a lot of talk of the wave of distressed loans that are becoming due second half of this year, particularly people who took out bridge loans, maybe got aggressive on the assumptions on the front end and bought in 2020, 2021, 2022 on really short-term type loans. Are we still seeing that? Is that still an expectation that there's going to be some of that coming later this year?
Yeah, I mean, I believe that truly distressed deals will be here by the end of next year. And like you said, the floating rate environment really started post-COVID in early 2021. That's when all the debt funds came back to the table and got really aggressive with their floating rate product. So those are the loans that are starting to come up for their 2-year anniversary, where people need to buy rate caps. You start getting tested at that level. Certain deals were only 2 years with 1-year extensions. We typically did 3-year initial terms with 2-year, 1-year extensions. So thankfully, we're not running into that issue. But I personally don't think the distress in the market is going to be as robust as other people do. The distressed sellers on deals are going to be those owners and the properties that have been poorly operated and poorly capitalized, and basically having their lender forcing them to repay that loan. At that point, they'll really have two options. They could either sell at perhaps a loss, which would create that distressed environment, or refinance into a new loan, which, as we talked about, it's very difficult in this environment. You're likely not going to be getting, if you didn't complete your business plan and grow NOI substantially, you're likely not going to be able to refi out your proceeds, which means you're taking a loan for less than what your original loan balance was, which means you either got to come up with equity or some type of preferred equity to come into the deal. And that is not always the best solution for a deal. This has been an extremely heavy focus of Ashcroft's and ours. And when I'm not buying deals, this is what we're working on. We're in constant communication with our lenders and working to ensure that we'll have no pressures to sell or refinance. Ultimately, I don't feel like lenders, based on conversation, I don't think lenders want to foreclose on properties en masse. They don't want to become landlords. They don't want to have what happened in 2008 and 2009 and figure out what to do with all the properties that they're now owners of. So they're willing to work with borrowers that they have relationships with, that they've been executing business plans. And so I do think between that, the creativity that we're starting to see in the loan space, that'll take some potential distress that we were originally concerned about or expecting, kind of kick the can down the road. And give the owners and borrowers time to let the capital markets settle, and then work through the payoff of the loan, wait for the capital markets to improve to sell the property or refinance the property. So I think the distressed deals are going to be more truly distressed deals that you're buying from poor operators that haven't really executed the business plan.
So taking all that you shared with us and really diving into Ashcroft, how are we evolving our discussion last quarter with taking a more calculated approach and really just setting ourselves up to take advantage of the opportunities that will arise and will continue to come to market?
We're absolutely being extremely selective on the properties that we're pursuing. Kind of like to the point where, I mentioned, the more core plus profile deals are the ones that are coming out. Those are what we're looking at. In times of uncertainty, you look at the markets, people flood towards gold and the commodities and the safe plays. Those core plus type deals are more of those quote unquote safe plays, deals with high quality deals, extremely strong locations, good demographics are all things that we're focused on. Given the lending environment that we talked about, we're looking at deals with fixed rate loans. So we're trying to work in the flexibility of them, but we're buying these deals with the mentality that, hey, we are going to hold it for at least 5 years or so. But in terms of kind of the calculated approach, on the distress side, we are taking a very targeted approach and doing a ton of research to find deals in submarkets that we like. As you suggested, we think on the outskirts and kind of the B locations, maybe where some of this more distress is, but we're trying to find that kind of diamond in the rough or so where there may be a distressed deal coming up in an area and a product type that we really like. So we're targeting properties and doing research that were purchased in the last 2 to 3 years, potentially looking at who the owners are, what their type of capitalization may be. We want to be in position on those deals when there is a time to say, all right, well, now I'm a market seller, I'll take my loss and I'm ready to go. We are hoping to be that first call on it.
Ashcroft, as things have slowed down, from our leasing agents who are, really upping that salesmanship, you didn't necessarily have time to do the last 2 years when, talking from tenants who are just flooding in and you're getting, 5 qualified tenants for every vacancy you have, to now we need to find these tenants. We need to follow up and make sure we're getting them in. And obviously on the IR side, being continually in front of our investors and making sure that we're having those conversations. So appreciate all that input. Any final comments that you might have that you'd like to share?
Hopefully in the next call, we'll be talking about a deal that we actually got under contract. As an acquisition person, a deal junkie, it's frustrating not having any deals. But to your point, like we are just being hyper focused on great deals, sticking firm to our prices. We're not looking to make a bad investment on the front end. We're looking to find a safe investment in a market that we feel strongly about, with a business plan that we feel strongly about, and also building in, as we've always done, a conservative underwriting. So, our expectation is to under promise and overachieve at the end of the day. And we want to make sure that we could still stay true to that. And so it's frustrating, but we know in the long run we'll hopefully be just fine.